We'd like to welcome everybody to the Notre Dame and Ideas Center series of webinars and podcasts. My name is Brian Ritchie. I'm the Vice President of Innovation and the Associate Provost here at the Ideas Center at Notre Dame. Just to start, I want to set some ground rules. Because this is a webinar, neither we as speakers nor the other attendees can hear or see you. If you have a question for us, please use the Q&A feature within the Zoom app, and we'll spend time in the last half of this webinar answering those questions. Today, it's our great pleasure to have Tom Crotty with us, and if you've seen previous webinars and podcasts from the Ideas Center, you know that we've been able to be very fortunate to have some very impressive guests, and Tom fits that mold as well for us. He spent the last 35 years in the venture capital industry, has assisted in the building of early stage companies, primarily within the information technology sector. He joined Battery Ventures in 1989 and moved into a senior advisor role at the firm in early 2013 after serving 12 years as the managing partner, where he was responsible for managing all investments and operational aspects of the partnership. Over the last 5+ years, Tom has become an active angel investor, and he's built and managed a portfolio of personal investments. He received a BA in business from the University of Notre Dame, where he's an active alumnus, and an MBA in finance from the Wharton School at the University of Pennsylvania. And if I remember correctly, Tom, you also played soccer at Notre Dame. Isn't that true?
That is in fact true.
Yeah.
Seems like a million years ago at this point.
I'm sure you could play pro soccer even today, Tom.
I don't think so.
All right. We've got a number of topics here, and we hope that we'll spawn some questions from you as well. Let me start by just talking a little bit about the challenge that universities run into around commercialization. As many of the listeners today know, and others have had experience, universities are a tremendous developer of new technologies coming from science and engineering and virtually all the other colleges on the campus as well. But the commercialization of those technologies is a difficult process. There's often a scarcity of early to very early stage funding. There's also very big regional differences. If I have a university inside of San Francisco or New York or Boston, I probably have access to resources that, say, a university in the heart of South Bend like Notre Dame probably does not, which creates opportunities but creates challenges as well. Tom, why don't we start? You know, you were one of the architects of the ND Innovation and Entrepreneurship Initiative in the effort to create an ecosystem here. Give us a little background on how that emerged and why it was created and what you hope to accomplish with that.
Now, it's a pretty long story, so I'll try to summarize it in an efficient way, but the story begins back in 2013 when I was asked to join and co-chair with Tom Burrish, Notre Dame's provost, a task force, form a task force that would take a look at research at Notre Dame. And the reason Tom wanted to put that task force together was kind of simple. Notre Dame, for decades, one of the pillars of our strategic plan has been a goal to be considered a premier research university. And I think that's an aspiration that many universities have, and it's a major challenge in terms of how to rise the ranks and attain, you know, the position of a premier research university. To put some context around where we were back at that time, Notre Dame in 2014 had 182 million of total research expenditures. Well, that sounds like a reasonable amount of money. If you took a look at the landscape of US universities, there was at that time about 207 universities that were considered to be in a group that had what was defined as high levels of research activities. Within that universe of 270, and those 207, none of them in that category that had med schools, because the med school is a whole different ball game than universities without med schools. So we were in a group of 207 universities with high research, no med school, and our ranking at that time was 69th. Now, if Notre Dame football was ranked 69th year in and year out, we'd be going through an awful lot of head coaches.
Right.
And so Tom, our research expenditures, which is the key metric that kind of helps, define where you sit in these rankings. Our research expenditures have been climbing, but not on the trajectory that we knew was going to get us in any, near-term period to premier status. So Tom asked me to convene a task force with him to study our research programs and figure out what are we doing right, what are we doing wrong, how can we improve, how can we change the slope of the trajectory. And those discussions began in the fall of 2013. We launched what was called the Notre Dame Research and Commercialization Committee. We referred to it on campus as the RCC. That was launched in January of 2014. And we put out and issued a final report in September of 2016. So this group of 14 members of the task force spent nearly 3 years digging through and understanding Notre Dame's research agenda and capabilities. And then in the course of that project, we also had to roll in commercialization, because you can't have a great premier research university without being able to bring technologies and intellectual property and ideas into the marketplace and commercialize them. So it became kind of the RCC, Research and Commercialization Committee. The final report had 24 recommendations in it. 2 of the most important and key recommendations relate to today's conversation. And the first one was that Notre Dame needed to create a hub or a centralized place in the university where all innovation, entrepreneurship, and commercialization could be managed. Those 3 areas, innovation, entrepreneurship, and commercialization, were kind of scattered throughout the university, siloed in a lot of cases, and we figured we needed a new model for how to bring this together. And
that's actually really unique, isn't it, Tom? I mean, most universities do have that scattered all over. So the idea of bringing all of those things together under one roof and getting all the synergies of that together, that's a very unique and big step.
It was, and we felt it was going to be core to being able to drive more aggressively and faster. Mm-hmm. And that recommendation led to the creation of the Idea Center, which was within a year of that final report. The Idea Center was up and running, and I think you were recruited and came to campus.
Right.
So that was a major recommendation of the report. The second and related recommendation was Notre Dame had to kind of step back and rethink the funding mechanisms for commercialization and research, but mostly on the commercialization side. There were a few pockets of capital available around the university, again, not centralized, not managed in a strategic way. And the recommendation in the report was, we needed to come up with a new model and a new mechanism to bring capital to bear, starting at the grant level, and then prototype level, and then alpha and beta, and then into the marketplace. And we needed a professionally managed approach to how to deploy that capital all the way through the various stages. Mm-hmm. And that, as you well know, led to the decision to go ahead and initiate a fundraising process to create a venture capital fund with Notre Dame as a general partner called Pitt Road.
Right.
And here we are today.
No, it's a great story. And I think there's a number of things that we ought to draw out of there that are really interesting. One was the thing you mentioned first, this willingness to bring everything under one roof. And there are real synergies in getting the entrepreneurship and the commercialization and the research connected together, all of that moving towards having impact, right? I mean, because the mission of the university really at the end of the day is to have impact. And by the way, that's true for all universities. I mean, there's so much intellectual property that sits inside the university and never gets out. So the fact that that was its focus, and then as you mentioned, making sure that we had the right resources to move these things through milestones so we could do the de-risking and get it from that discovery all the way to the marketplace, right? So you're a former managing partner of Battery Ventures. I mean, this is a hugely successful venture capital company. And why should a university be even doing this in your mind? I mean, you talked a little bit about how important it was for us to be able to have the right funding at the right time. And we're trying to connect this with a process, but you've been now involved doing this with us for a period of time. What are your thoughts on that?
Well, as we were going through the process of the RCC and then the standing up of the Idea Center and raising Pitt Road, we're looking around at other models at other universities. And, quite candidly, there's no one right way to do it. And there's many different models out there. I know we had some really interesting discussions with the folks at Caltech about their Kairos Ventures Fund. MIT does it their way, Carnegie Mellon does it their way. There's no one right size fits all model here. And a lot of it has to do with the chemistry and culture at the university. Tom Burrish, to his credit, and to the rest of the senior administration, were very open-minded about what model Notre Dame might take. And we did our research. We looked at a few different approaches. And, I don't think there's a more refined and more effective model than the pure venture capital, general partner, limited partner, professional management team doing appropriate due diligence, managing a portfolio from start through exit. It didn't seem like we needed to reinvent the wheel, that model is a great model. And there was no particular reason that we saw why a university just couldn't adopt that model. Different, but in a way, I guess we're pioneering, taking a very well-established model, but moving it into a new ecosystem that had tried many different alternative approaches, but very few had settled on this approach.
It's a great point, Tom. I've noticed in our work that one of the things that has been a real benefit of adopting that model is it's allowed us to both transform that model a little bit and transform the way that universities think about this kind of funding. So for example, we don't have to say we're limited to a specific industry or we're limited to a specific check size or some of these things that venture funds are often limited by, because we have a process internally as this is going along where we take small bets in technologies and then just pile on the winners. So the process provides the discipline that maybe a venture fund would have to find in other places. And yet we can use that same model to make sure we've got all the right incentives aligned with all the right stages, right? So we can get the right amount of money to work on the right projects at the right time and making sure that we don't have any waste. So we can prove things for very small amounts. And then if what wins goes forward, we can pile on and stay whole as a venture fund would do. So I think that we're seeing some really great synergies and advantages from this in applying that model, but also tweaking the model a little bit.
Yep. I think that's all correct. And one of the interesting things that we had to really talk through as we were establishing the model for Pitt Road was, is this just a university IP program?
Right.
Where's deal flow going to come from? If it's coming from outside the university, if it's come from the alumni group, how are we going to deal with that? And I'll throw it back to you, because I think you drove the decision-making around how we should think about that and approach it. Because no venture capital firm is going to be successful if they have modest amount of deal flow.
That's right.
So I'll tee that up and throw it back to you.
No, it's a great question because, there's certainly a handful of universities that are producing so much internal research that they wouldn't have this problem. But there's a lot of other universities as they are building their research portfolio that's going to take some time to actually create that critical mass. And so we said, and we, at the end of the day, everyone agreed that we should do this not only for faculty, but could do this also for student technologies, could do this for alumni technologies, and even for the community. One of the real advantages has been that we've been able to start to build the relationships with local capital in the South Bend Elkhart region that's starting to build out this ecosystem from a technology standpoint. So I can see the day down the road where, you know, subsequent funds may do mostly faculty research, but at this point in time, it's made a lot of sense for us to open that up a little more broadly.
Right.
Yeah.
And talk a little bit about the deal flow in terms of those buckets. Where are we seeing the most, and where do we need to kind of improve our deal flow?
Yeah, it's interesting too, because each of those buckets bring deals at a little different stage of development. Again, those that are really engaged in university research know that those early disclosures are really early, and they're very nascent, and they need a lot of de-risking. And so we're working on a lot of those. I'd say probably 25% of what we're investing in now is coming from the faculty at the university, and another 25% from students. Both of those buckets tend to be early, tend to need pretty substantial de-risking. But the ones that we're getting from the alumni and from the community tend to be a little further along. And we're able to get them a little bit later in that process, which is allowing us to also set the fund up for success in terms of when we might see exits. And the fund has already seen one exit, as you know. It was small, but it was one of these that had connected to the community and had done some commercially sponsored research back to the university and had created a product that was a little bit further along. So we were able to see that exit happen a little sooner, which again, kind of creates a differentiation within the portfolio in terms of the maturity of the projects in which we're investing. But I think I see that changing over time, but it's been a good place to start.
Just for context for all the attendees, what's the size of our annual deal flow? How many deals do you look at in a year?
Yeah, we see about 500 at the top of the funnel. And for all of those that want to know as well, the fund is 22.65 million. So it's not a huge fund, but it's a substantial fund. We initially went out to raise 15 million, and the fund was oversubscribed, and we cut it off. We didn't want too big a fund to start. We wanted to make sure that we could place it appropriately. But we see about 500 deals at the top of our funnel every year. About 40%, 40 to 50% of those will fail at the first stage of our analysis, which really is on intellectual property and market size. And then in the second de-risking stage, we'll lose another 50% of the ones that go forward. And we end up with 10 to 15% that come out as really solid investable deals at the end. But we start investing earlier, but it typically tends to kill the deal, not finish the deal. The ones that come out are about 10 to 15%.
So we closed the fund in May of 18. I think we did a 2-close process. May 18 was the first close.
That's right.
The second close in like July of 18. So
that's exactly right.
We're approaching 2 years in. How much of the fund have you invested at this point?
It's gone very rapidly, much more quickly than I had thought it might. We're in 27 companies right now. We're about 63% of the fund committed, about 30% of the fund invested, and about 63% of the fund committed. It'll be interesting to see how this goes given our COVID challenge at this point, but we were on track to have over 70% of the fund committed by the end of this year, calendar year. So that's about right, about a 3-year time frame to invest. Now, the fund is a little different than most seed funds in that we are back end heavy because we want to be able to get all the way to exit with these funds. So we're investing about 1/3 of the fund up front and following with about 2/3 of the.
So you're going to reserve almost 2/3 for follow-ons.
Right.
Yeah,
that's right. We found through experience that if we can't get all the way to the exit, we leave a lot of money on the table. And one thing that a lot of administrators, and this is a question I'll put back to you, and maybe we can both talk about it, is how did we get the people at Notre Dame in the higher administration capacities to be willing to do this, right? I mean, this is not something that most administrators in universities are willing to consider for obvious reasons. How did we get this here, and why is it important that we succeed? Because I think that there are some real reasons to think about this as a tool to help universities move forward. And I'll give some ideas after you give some of your ideas.
Yeah, well, I think without that RCC process and provost level commitment to the whole idea, it would have never happened. But because it fell out of the logical task force approach, and the understanding that without capital, you're going to strand all that great intellectual property that the faculty and the grad students are developing. And there was no obvious place to find the money. You know, it's not like Notre Dame had 22 million just sitting around. They could just give you and say, oh, go to town, Brian, invest it. You know, it took a while. You know, you get the general counsel office obviously got involved and had to get comfortable with an independent return on investment vehicle. This is not a benefaction vehicle. It's a return
with external LPs, right? I mean, that's another big part.
Right. And so, you know, it took a lot of time and effort and dialogue with multiple departments within the university. But eventually, you know, I'll be honest with you, without a lot of anxiety or angst, the decision was made to green light Pitt Road. The LP base, what do we have, about 25 LPs, is it?
It's actually more than that. We have actually close to 40 LPs.
40 LPs, sorry.
Yeah.
And I think we had, what, a $500,000 minimum.
That's right.
And it's always obviously got to be qualified investor individuals.
Yep.
The LP base is primarily alums, but also local. We had parents involved, Notre Dame parents. We have Notre Dame alums. We have local organizations, some foundations, and local individuals who are not necessarily Notre Dame ecosystem. So it's a pretty balanced, I guess, LP base, and not necessarily just purely Notre Dame. So,
that's right. That's right.
And I think people are probably curious just on the terms of the fund. You quickly talk to the terms, the economic terms. Yeah,
the economic terms. So we did a 3 and 20 in this first fund. So 20% carry, 3% of the fee. And I mentioned the 22.65. It's a 10-year investment period fund with the opportunity to extend an additional 2 years, which we think is the right length. That's pretty typical for a seed stage A-level fund anyway. But
might be too short.
Might be too short. That's right. That's right. So so pretty standard from that standpoint, which I think has been good for us as well. And I think that we're finding that we could probably run the fund on actually a more standard 2 and 20 really effectively. We didn't know that up front, but we've learned a lot as we've gone through this.
Which is why Notre Dame is fundamentally important as the general partner here, because in essence, they're contributing a lot of the overheads that the fund wouldn't have to use its fees for, right?
Yeah,
I mean, we're using the Idea Center facilities. You're being paid by the university, you know, so there's some interesting synergies that don't mean that you have to drive the highest fees. In fact, I think didn't we agree it's 3% up until we raise fund 2, and then it drops,
then it'll go to
2%. And then in year 10, I think it drops to 1% fee.
That's right.
So
that's right.
Allowed us to have some, you know, a little higher fee at the outset for some startup costs and things like that. But it's a traditional VC, you know, organized and structured fund, and seems to be working great 2 years in.
Yeah, and you know, I love that the real advantage to the university are twofold that I want to draw out, because I think they're important to recognize. Because there's no bite size, it allows us to take small bets on technologies that might otherwise not move through the de-risking process. So we might put 10,000 or 25,000 back into a lab to do some additional work to really make sure that there's a customer, or that the technology is validated, or that, you know, we could get to a prototype or something like that that really moves this along. And if it wins, then we can actually bring in external investors to invest alongside us to continue that process to go forward. So there's a real research advantage, development advantage. Let's call it a development advantage for the technologies at the university. That's one thing. The other thing that a lot of people don't appreciate is that if this is successful and helps with the return, monies back to the university are all unrestricted, right? So they can be used for anything. They can be used for students, they can be used for buildings, they can be used for whatever the university needs. And those of us that are well-versed in the endowments at universities know that a lot of those monies are restricted, hard to spend, difficult to you know, be agile with. So I think there's a real upside to getting this right from from a financial standpoint.
Right. Right.
Yeah. Well, let me go to the questions. We've been about a half an hour in. We have a couple of questions here, and I'll just throw a few out to you as we go over these. So it says in the 2015 Idea Center proposal and the NDRCC report that alumni are described as SMEs or investors. Would love to know your thoughts, Tom, on sourcing deals from alumni founders. Any advantages to alumni clients versus at-large clients with no Notre Dame ties? Maybe we ought to talk a little bit about the Notre Dame ties. I mean, why was that important to us that we wanted Notre Dame ties, went after that, both for our founders, our investors, our connections? Talk a little bit about that.
Well, I mean, you know, you're not going to find a more loyal and dedicated and enthusiastic alumni base out there than Notre Dame's alumni base. So, you know, when you're starting up a new fund and you're trying to get your sea legs, you start with family. And the Notre Dame family is big and it's broad and it's really willing to help and roll up its sleeves. So, you know, it started by thinking through who are the obvious limited partner targets, who had the sophistication and could bring some value to the table as early investors. And then, you know, broadens from there to, I know we have so many vibrant programs within Pitt Road and within the Idea Center to leverage the Notre Dame parent and alumni network to bring talent to these startups, both at the board level, at the consulting level, to open up doors and try to, you know, get customers and early revenue. And I know you spend a ton of your time building out your network of alums who will just roll up their sleeves to help the portfolio companies that we have.
That's super important to us. That, in fact, the success of the fund, I think, largely will be based on the help that we've gotten from so many people.
Right. So it was fundamentally important that we start with the core asset we had, which is the alumni base. The parent base turns out to be a pretty nice add-on to that because they become such raw parents, even if they didn't go to Notre Dame. And so that's an extension of the network. And I'm not sure if I fully answered the question, but.
No, I think that's right. I think that it's a place to start. It doesn't mean that that's where it always has to end, but we needed to get to the right people who would give of their time as much as they would of their financial resources to help us with this. And again, you know, it's not a benefaction fund. So this is an ROI and they expect us to have an ROI, I think, which is an important driver in aligning interests.
Certainly for the LPs. And what I've been so impressed with is how many alums are willing to roll up their sleeves and help you, even though they're not LPs and they're not going to get a personal ROI monetarily anyway.
That's right.
Out of the work they do for us, but they just want to help.
That's a great point. Got a question here from a listener. Said, how did you overcome objections by university compliance officers that an ROI fund would conflict with ND's not-for-profit status? Was this even an issue for us? I've got a couple of thoughts on that. How about you? Did you run into? Do you want me to go? Okay, so
you start.
So you know, it turns out that universities already with foundations are already investing for profit and for return. And so there's a lot of experience that they have in this space already. But we were able to create the structures, and we'd be happy to help others that want to do this to see what we've done here so that we would not run afoul of those issues. I mean, they were certainly questions that our OGC was asking, and we were able to figure out how to do that. But it turns out that that wasn't as difficult as you might have thought. I don't know if you have other thoughts on that.
Yeah, I think that there was to the degree that there was angst and anxiety within the administration about this concept of an ROI fund, it was really around conflict of interest.
Right.
And, you know, and who was going to be investing and whether that would optically create a conflict or you know, open us up to second guessing and that kind of stuff. But, you know, conflicts of interest are really, they're not, if you're transparent and you disclose and you explain and you don't try to hide, and you don't try to hide, then there's really not a lot of conflict. And we put out a PPM. We we put it out broadly. We didn't cherry pick who the LPs were going to be. I really think the administration was being forward thinking and forward leaning, and got comfortable with it. And, we're 2 years in and there hasn't been a peep or an issue or a problem or anything
Right.
that's cropped up. That doesn't mean it won't happen somewhere along the line, but so far so good. And I think that's the key issue. Just disclose, just tell everybody everything. And then you won't get yourself in trouble.
Yep. No, I think that's a great point, is that we're very heavy on the management and the transparency and the disclosure, and that has been a great way for us to stay on top of this. We have another question here, wondering if we're aware of the new Business Preservation Act and the Endless Frontier Act. And if we're familiar with either, what are our thoughts? I don't know if you saw this, Tom, but the Congress is now thinking about a new act called the Endless Frontier Act that will completely remake the National Science Foundation into a National Science and Technology Foundation, and that they'll add $100 billion to helping universities and other organizations commercialize and have an impact with the technologies that are being developed from that research. I know I personally was extremely excited to hear about this, because I think that this will fit perfectly with the advanced thinking that's come out of the work that you and others have done to get Notre Dame on this trajectory. I think that we're going to be set up really well to take advantage of those things as we go forward. I don't know if you've heard much about this or have many thoughts.
First, I've heard of it. So I think being in quarantine and being in shelter, I must have missed it somehow. But that sounds to me like a great use of capital, because it will gain leverage.
I totally agree.
And multiple dimensions for the country: job creation, intellectual property creation, and return on investment if it's done right. And I don't, given that relatively high level explanation, it seems like something that would be quite interesting and something that we should be thinking about supporting.
Yeah, absolutely. And I'm looking forward to seeing what comes of that. I think we'll be able to take advantage of that, as will a lot of universities that are thinking, innovatively about how to do that. I have another question here about what is the co-investing model? This is a fun question, and I think we can both add a little here. So one of the things that has presented itself is, as we take these small bites early on and de-risk these technologies, it becomes pretty obvious pretty quickly that there are opportunities for others to be involved. And frankly, those are great validation points for us. If we can convince others to invest in our projects with us, it helps us spread the risk and also helps us recognize where we're finding value. So we open this up to other venture capital companies, angels, friends that want to co-invest with us, to the LP base, and make these opportunities available. So if you're an accredited investor and you're interested in participating with us, we'd love to have you join our ecosystem and get familiar with some of the things that we're doing. So that there's a lot of opportunities there.
From my position on the Pitt Road Advisory Board, I don't have full insight on the portfolio, but my sense of the portfolio is it's been very early stage.
Yep.
Seed, pre-seed, some Series A. It's been, I think, beyond just us, we've had a few institutional players doing deals with us, but more so we've been getting angel investors side by side to us in most of the deals so far. Is that correct?
That's exactly right.
I think we're probably, with our portfolio being on average probably no more than a year old, some of the oldest ones being 18, maybe close to 20 months old, we're going to start to get some of the maturing ones looking for Bs and Cs eventually. I think that's going to take us into a whole different ecosystem of investor that We're really not dealing with right now. But, if these companies are progressing the way we want, we're going to want to have the established venture capital ecosystem back in these deals.
Yeah, no question. One of the advantages we found is that sometimes these early investors that come in alongside us are capable of leading the A's and the B's later. And so getting them into the rounds at this point, get them socialized with the companies and get them, comfortable doing that a little bit later on. It's also bringing capital into the region. we're leveraging capital now that might not have ever come to this region based on the deals that we're helping to put together. So I think that's a benefit for the ecosystem as we're developing it here.
Right, right.
So but one question here said, did the Board of Trustees have to vote to approve the fund?
I do not believe it ever went to a vote at the board level. No.
No, it didn't. No.
No, I think it was a vote within the senior administrative team.
Yeah, that's right. That's right. And then another question here, interesting, is the fund GP owned by Notre Dame such that its audits roll up to the overall university audit? And how is the arm's length process managed by auditors? So do you want me to jump on that one?
I know we, did we just switch auditors like a year into the fund or something? I can't remember what we did, but I mean, obviously we have outside auditors.
We have outside auditors, yeah. So the fund has its own set of auditors that are independent of the university, but the accounting of the fund rolls up through the university. So the audit is done externally and then presented to the university, then becomes part of the overall university audit as well. So it says, if we as alums are leading around in our ecosystem, should we consider referring those companies to the fund? What do you think about that, Tom? How would you answer that?
Hell yeah.
Hell yeah.
If they're good deals, we want to see them. Yeah. I think, right now, I think the goal is to have some Notre Dame DNA in every deal that we do. And so if there's a Notre Dame alum is either, in a company or on a board of a company or is very close to a company and thinks, or
even the investor in a company, we've done one, right?
Yeah, right. So
is the lead, yeah.
Right. So I think the answer is, we want to see good deals. So I don't think we would, I don't know, Brian, you tell me, but if something just kind of came in over the transom out of the blue, had zero Notre Dame connectivity, but somebody found Pitt Road and sent you a deal, would you spend time on it?
No, we wouldn't do that deal. That doesn't fit that doesn't fit really what we're trying to accomplish in the long run. We have done, as you know, a couple of deals that were a little bit older, I'll say a little bit larger, that came to us through ND fund managers. So if you're a fund manager and had a project and wanted to connect with us, we have done a couple of those. Now, again, that's a very small proportion of our fund. It's about 5% of the fund. And we did that for the age-related issues of the fund and the return. But most of what we do, we want to go through our process. That's really when we talk about the thesis of the fund, it's going through the process, the de-risking process, and having us add some value to the deal.
Yeah, just to put a point on that. So the advisory board, there was a big discussion within the advisory board of do we want to do some later stage things where we're being offered, $300,000 or $400,000 position in a much larger, more mature company, but just because it's a Notre Dame controlled situation, they're offering us that opportunity. And as a board, we debated that and decided that we would earmark a small percentage of the fund to try to do some of those opportunities because they are later stage and they would help us avoid the J-curve factor of your lemons ripening early before the good ones kind of bring you back out.
Yep.
So if we could get some slightly more mature deals in the portfolio and balance out the return profile, we felt that was a good use of capital.
And in fact, just to again put another point on that, the way that we're working with, we have about 100 or so VCs in our network that are interested in kind of working with us in some form. We're much more interested in bringing them in to look at our deals as we are us going out to look at their deals in terms of the way that the fund is operating and running. So that's where we're better positioned. We have a question here about how many FTEs are used to support the fund. We have 2 dedicated FTEs that we pay out of the management fee. We also use the management fee for other consultants and others that we might need to do some of the de-risking. Unlike a lot of funds that might use that to do some due diligence, we might use some of that fee to actually do that work to determine if we could get to a prototype or a proof of concept. So in that case, the funds might be used a little bit differently, but they are adding value back to the fund as well directly. So I like the way that that's structured.
You
Um,
should,
Go ahead.
Brian, you should, I think that question begs a conversation around how you leverage the Notre Dame undergraduate and graduate students and get incredible amounts of leverage, both in the diligence and other areas, and how you do that.
Oh, I appreciate you asking that, Tom, because that goes full circle back to the formation of the Idea Center to begin with, right? I mean, the ability to bring all of the different components together under one roof meant that we could access students in a really productive way. So we have at any one time about 150 students working with us in various aspects of this de-risking process. And that includes on the fund. So that's been a tremendous advantage to us to use all of that talent to help us do the de-risking and the work on these different companies.
And such a win-win. So now you have 150 students across, from freshmen to seniors, and some graduate students as well.
Across the whole university.
Right. And these kids are learning entrepreneurship. They're getting into analysis on markets and products and technologies, and helping to size up deals. This is great real world experience these kids are getting, above and beyond just the classroom work.
Yep, exactly. So, and that experiential component of that learning, I think, is one of the things that drives the value proposition of a Notre Dame education. And we feel, that's important for us to contribute to that.
While we're on this point, I think it'd be worth talking about the Idea Center's role in trying to improve the entrepreneurship and venture capital academic classroom work, and your role in trying to lift that boat as well.
Yeah, no, that's great point. So because we're all under one roof, we've been able to create a master's in entrepreneurship, primarily for STEM related undergraduate degrees, as well as a minor in entrepreneurship that is open and available to anyone across the campus. So it doesn't matter which college you're in, you can take it and participate in it. But a big part of that is, in both cases, a capstone experience where you either have to start your own company, work with another startup, get engaged in the investment component of that startup, and get a real world experience on how that actually works. So it's one thing, as you know, to read about that in a textbook. It's another entirely to go and do it. And,
right.
And that's what we're putting in place for all of those students, which is a win-win, as you mentioned. We get help in the projects we're working on. They get real world experiences and applications. And then what we can do is make sure that what's being taught in the engineering school and the business school and the design school all aligns around what it is we're trying to accomplish from the Idea Center.
Right. Yep. So the Idea Center's got a multi-dimensional role that goes beyond just commercializing technology, but is intimately involved in the academy as well. So I thought that was an important thing to draw out, make sure people understood.
Yeah, absolutely. Oh, we have some really great questions here. One is asking, have we developed relationships with VCs as potential syndicates? Absolutely, with lots of them, and we're interested in developing that more. By the way, one of the real opportunities is for us to develop a coterie of these VCs in different segments, right? Like healthcare, SaaS-based software, engineering, in order to get the right kinds of partners onto the right deals. Another question here, the investments made primarily into student-led companies, or is the focus on alumni-led companies? We do it across the board, but this is interesting. What has been the experience with working with younger founders in the fund? Any thoughts on that, Tom?
You're in the trenches doing most of that work. It's my observation from my own angel investing, and watching and seeing what's going on within the Idea Center in Pitt Road. It's both a blessing and a curse.
Yeah, exactly. We get a tremendous amount of energy, but a low amount of experience, right? So
yeah, I mean, you love the enthusiasm. You love the just how committed these young people are. It's a joy to work with them, but it's a challenge because they don't have a frame of reference. They've never done this before. They're getting input and advice from a gazillion different, people, and you have to kind of find ways to disabuse them of a lot of things that they've been told that, and just are not quite right, because they're sponges and they'll listen to anybody. So it's there's another Mark Zuckerberg running around Notre Dame somewhere, I'm sure.
Right.
And and it's our job to try to help them. And it's also our job to sit them down and explain that the company is at a point where their skill set is holding it back.
Yeah. But it also points to the importance of the point you made earlier, which is if we get the right mentors, the right advisors, the right board members, the right sort of adults in the room, quote unquote, then we can really provide that kind of direction and teaching, which becomes part of their experiential learning as well.
Right. Yeah. Exactly.
Great point. One listener is asking about the actual structure of the deals, the terms of the deals themselves. Do we take equity for these investments, for example? The answer is yes, absolutely. And we do it in the form of convertible notes or safe notes. Sometimes we'll do it in mixed returns where we'll do a little bit of debt, but mostly it's equity in exchange for the work that we do or for the money that we put into those companies. There's a lot of questions here about working with faculty.
Hey, Brian, before you get off that, you might talk to how at the very earliest stages when things are at the bench level, how we're doing grants.
Yes.
And how those grants can then be leveraged into downstream investment and that kind of stuff.
Yeah, no, that's a great point. So we actually created 3 funding buckets. We created a very early grant stage research helping fund, as well as then a gap fund to do technology development to get us to first stage proofs of concept. And then the fund investing at that stage for equity as we get the companies started. So the first 2 we don't take equity for, although we do track them. And when it comes time to do the license with the company and or an external company, the startup or another company, we'll either take more in a percentage of royalties or in equity at that point in time. We did have one question about how we do that when we haven't yet formed the company, and that's how we do that. So we do track that. And we do consider that when we go through the license negotiation. The fund invests pretty early as well, very small amounts, usually 10K or so. But we do take equity for those in the form of a safe note, and we do get the company started at that point in time. Just along these same lines, some people talk about how hard it is to work with faculty and that sometimes there's a lack of urgency and other things like that. But a lot of times we'll work with their grad students, with their postdocs. Sometimes we'll bring in other founders to work alongside the faculty member, because it is true in many cases, if you wait for the faculty member, I'll be long retired or dead before we get a return on that investment. So that's some of the things that we do there. Here's a one. How might the pandemic affect the portfolio and future deal flow? You're out there investing, Tom. What are you seeing?
Well, I vividly recall in, late March, when everything started really shutting down, the advisory, we had our advisory board, and the key topic of the meeting was, what are we going to do with the portfolio, and what is our advice and our approach with every portfolio company to help them navigate through what the storm that was hitting. There's very little one size fits all answer to that. It's company by company. But the overarching thesis was that batten down the hatches, reduce spend every single place you can.
Right.
Let's put off hiring. I think the idea center is also where these companies start themselves, and they use our facilities and they pay small rent. I think didn't we agree that we chopped their rent?
Yeah, we did. We gave them a couple of months for free too.
Right. So we did things to help them bring their overheads down to make sure that the cash on hand was going to last as long as possible. What are the other steps that we took, pieces of advice we gave the portfolio?
Yeah, I mean, really cash was king, right? I mean, as you came through this, and fundraising right now, as you know, is also very difficult, and it always is in these environments. So it's how do you extend that runway as far as you possibly can. We were fortunate that a lot of our companies weren't yet to market, so they, in some ways, they've been able to just kind of plow through this period of time. We've still been making investments, and we've still been, doing the things that we've been doing, but there were a few companies we had to work with through this period of time. Yeah. So another question, is there a specific structure requirement for the portfolio companies, S Corp, C Corp, LLC, and why or why not? We do encourage all of our companies to be C Corps, and we set them up as C Corps just because that's the easier way. It's not that we've never done an LLC, but we like them to be C Corps. I don't know if you feel the same way in your investments, Tom.
Yeah, there can be, based on the business model, a good reason why it's one versus the other versus the other. But generally speaking, I think it's the safest and most expedient and least complicated is to go straight C Corp. But if there's other valid reasons why that doing something else makes sense, I've always been open to it, and I know that you guys are as well.
Yeah, exactly right. Here's a question. Who's on the investment decision team? Is it a majority vote or does it require unanimous vote? And how is a yes/no decision made? The investment decision team is internal. There are 3 members of that team. It's myself and James Thompson and Matt Gardner that make up that investment decision team. It is a majority vote. It's not a unanimous vote. I, as the head of that, have to vote yes for that to happen. All of our decisions over a certain amount go to the investment advisory committee for their input and guidance on these as well. And we try to be very transparent with that committee on everything that we're doing so that they have a good sense of what's happening and how we're thinking about the deals that we're putting together. So that's how we've structured that.
And just for clarity, the advisory board doesn't decide yes or no, but deals of a certain size, we want to kind of kick it around with Brian and the team and help them think it through, and just be a voice, added voice to their decision-making process.
Yeah, which has been tremendously valuable for us. I mean, whenever you get an advisory committee that will spend the time that they have to help us think about these things and give their input, and with all their years of experience, has been a tremendous asset to us. Here's a question right to the heart of the RCC, Tom, for you. It says, as a Catholic University, Notre Dame is a USCCB compliant investor, which is true. Were other Catholic investing groups, the KFC, Catholic Investment Services, or other Catholic universities examined when developing Idea Center's own mission statement?
That's a thoughtful question. And I think that the answer is no. I can't, we're talking 2013, 14, 15, so it's a while back now, but I don't recall as a part of the RCC's process that we spent a lot of time looking at other Catholic institutions' models and approaches on this stuff, to be honest. We were spending time looking at best practices as part of the committee process. We had meetings out at Stanford. We had meetings at some other universities, some labs, both federal and corporate labs. And, we did a lot of best practice type work, but I don't recall a Catholic, other Catholic schools or other Catholic organizations component to that best practices work we did.
Yep.
Maybe that was a miss on our part at the time.
Yeah, no, it's an interesting question. I know that as we've gone forward, we've given that a lot of thought. And in fact, we've started to reach out to more of those groups at this stage as well. And hopefully that will continue to inform the decisions we're making for this fund and decisions we might make for potential future funds. A couple of things here that I think are interesting. We're just about out of time, so maybe we'll try to do one or two more here as we wrap up. But one of the questions here is how the fund differs in its approach to life science technologies as opposed to other kinds of technologies. And I'll just comment on that really quickly to say that there is no question that specific components of the life sciences, especially drug discovery, pharmaceuticals, therapeutics, diagnostics, they just take more resources. It's not that the fund hasn't made investments in those areas and will continue to do so, but we're looking for partners early in those. We want to get to validation points as quickly as we can to bring in the outside capital that are necessary to take that forward. So far, we've been successful doing that, but it is a harder road. There's no question about that. Let's do one more here. If another university fund invests in some technology that touches, has exposure, or participates from ND, would we consider co-investing?
I would assume so, Brian, but you're the fund manager, so I'm going to let you answer it.
No, I think that's absolutely. All right, here's one last one we'll do. Stanford and MIT startups have built-in geographical advantages, e.g. proximity to large numbers of established high-tech companies, large regional talent pools. What corresponding geo advantages does ND have, and how do they factor into the fund strategy? That's an awesome question. Let's take that one. We'll end on that one. What do you think, Tom?
I think Notre Dame's advantage is not a geographic one per se. It's just from where we reside in the country. In fact, you could say that's
a disadvantage, probably.
It's a disadvantage, there's no doubt. And what we're trying to do is counter that with the Notre Dame family and rallying the Notre Dame family and all those assets and all that experience and that knowledge and bring it to bear. Having said that, this pandemic may be altering that dynamic as we sit here today.
I agree.
People are now going to be hired and are going to be working remotely. And I think, while it'll never completely erode the geographic advantages Stanford and, any of the Boston schools have, or, they're always going to have that advantage of the vibrant ecosystem that everybody can leverage up together. But it's going to come down and it's going to allow organizations, universities, and startups and other businesses the opportunity to thrive a little easier than historically.
Yeah, no, it's a great point. One of the things we've recognized is that while we're not in Silicon Valley or Route 128, we have access to a tremendous resource in our alumni base. And our ability to connect with those alums, and by the way, this is one thing Notre Dame has done that a lot of other universities have struggled to figure out, is how to give access to their alumni base to certain components of the university, right? In some universities, they own their alums in the different areas. That's not true in Notre Dame. We've been able to get access to and leverage the abilities of our alumni base in all the different areas we've needed. I'll give you a quick example. We were looking for pancreatic oncologists for a technology we were developing, and we needed some feedback. And within one day, we were able to get 20 pancreatic oncologists on the line to give us feedback on a technology. So even though we're not in Silicon Valley or Boston, I feel like we're able to leverage that asset in ways that are really important. And I would say, if other universities are considering this, you need to figure that one out. That's an important resource that you need to learn how to be able to get access to.
I couldn't agree more. And that's why this Pitt Road and the Idea Center first and then Pitt Road second being top-down driven is such an important component to it, because Lou Nanny, who runs development at Notre Dame, is an ally.
That's right.
He understands that Brian needs access to him and his database to touch people, and he's been a great ally to the fund and to the Idea Center.
And he recognizes too, Tom, that if we have an LP in our fund who is making an investment and we can help build a return and do something really great for the university, it actually makes them more likely to be a donor. So in some cases, you get universities like, oh my gosh, I can't let you go raise money from my best donors, or they won't give money to the university as a donor. That's absolutely has not been our experience. Our experience has been that the more engaged they get with the Idea Center, the more willing they are to participate in philanthropy at the same time.
Right. I think so many of the LPs that when they were approached with the private placement memorandum were shocked that they weren't being asked for a donation.
Yeah, that's right.
It was like very refreshing, like, wow, this is ROI? Yeah. Yep. sign me up.
That's right. And by the way, it was their generosity and their willingness to participate and their willingness to support made that fundraise very easy. So it was great. Well, Tom, we really appreciate your time today. Appreciate your willingness to be engaged in what we're doing here in Notre Dame. I will say to all of those listening that if you have additional questions and it's possible for us to answer them, we'd be happy to do so. We were unable to get to all of the questions, for which we apologize. It wasn't possible. But if you have questions or want to engage with us, we are committed to helping you do this at your university if possible. We'd love to do all we can to lead and help you in that area. So if there's something we do, please let us know. Again, thank you, Tom. Really appreciate your help. We'll be turning these into a series of podcasts. If you have not been out to see previous podcasts, we'd invite you to do so. They're all on our website, and that's where these will be as well. So with that, we'll sign off and wish you all a great day and hope to see you on a future webinar podcast from the Idea Center. Thanks, Tom.
Be safe, everybody.
Bye now.